Hi, and welcome to our presentation. We are going to be assessing the microloan program of Alterna Savings Credit Union. We're going to start off by giving you a summary of the case, and then we're going to move into our assessment, which I will explain to you in the summary as well. And then we will end off with some discussion questions so we can get our conversation going. So to start off, the purpose of the evaluation was to strengthen the existing microcredit program. They wanted to strengthen their internal management, external recruitment practices, and allow them to tailor their new financial products to successful borrowers. So the overall goal of the study was to assess the financial and social impact of the community microloan program, with specific objectives of informing Alterna's new CSR policy and providing a better understanding of what was and wasn't working, anticipating the risks of faulty loans, and contributing to the international debate on effectiveness of microcredit as a tool for poverty mitigation. Now we'll move into their findings. So throughout the study, they assessed the program at three levels: the micro, meso, and macro level. At the micro level, they assessed the socioeconomic status of the microloan borrowers and their households. They found that 2/3 of all borrowers had small businesses as a result of the microloan, which represented their primary source of income. And 41% of people said the loan improved the socioeconomic status of their whole family. At the meso level, they assessed the reputation, brand, and customer loyalty of Alterna. They found that 75% of borrowers only borrowed once, which they assumed was due to their increased earning potential, and 91% of borrowers paid back their loan on time, meaning this is a solid line of business for Alterna. It is also a great marketing tool for them, and they had very good retention of their borrowers. 35% of these borrowers made Alterna their primary bank. At the macro level, they assessed the revenue and expense of the municipal and provincial governments. They found that the loans had a positive outcome on the wider community, as 37% of borrowers hired an average of 2 more employees, which increased government tax revenue and also decreased the draw on government assistance programs, because 41% of borrowers used government assistance when they started the program and only 21% did so at the time of the study. They also did an expanded value-added analysis, seeking to determine the monetary value of otherwise hidden contributions of the microloan program. They found that $266,630 of value was created for 2008 and assumed that this would continue. They conclude by stating the implications of the study. So because of the study, they're able to grow their program as a part of their CSR initiative. And also this they want this to lead to further policy developments. They want it to be evidence for the government to support further microloans and other financial literacy programs. And the final implication is that they use this study as evidence that more mixed method social accounting should be undertaken in the future. So now I want to move into the methodologies that they use to conduct this evaluation. They used a mixed methods approach, stakeholder engagement, and a logic model analysis. We will be diving into each of these methodologies during the presentation to give you a better understanding of how they were conducted and to provide an analysis of how we think they went. So hopefully you'll be able to draw your own conclusions about mixed method social accounting evaluation by the end of this, and we'll be able to have a great discussion about these methodologies. Just as a little preamble, we relied very heavily on theories discussed in class and in the readings to assess these methodologies, so please keep this in mind as we move through the presentation. Now I'd like to move into the mixed methods approach. So I will start with a bit of an outline of what that looked like. So for the evaluation design, it was non-experimental, there was no random selection of participants, and no comparison group. They did talk about why they didn't do this. They said that randomization was unfeasible for a variety of reasons, such as their modest budget, and there was no easy comparison group to compare to their group of borrowers. They did use a lot of different sources to bring in their data. They did interviews, so they had 13 interviews in total with Alterna staff and also with Carleton University staff who were the evaluator. And they also did a document review of scholarly and professional papers, as well as some documents from the Alterna archives. They also did semi-structured questionnaires and focus groups on key outcome indicators such as employment, credit status, and welfare assistance. And they also did online semi-structured surveys, as well as a virtual focus group, and these were more focused on the borrowers. They also did 10 case studies. 7 of these they did with borrowers who paid back their loan on time, and 3 with borrowers who did not. Moving on to their sample, the total sample was 142 borrowers from 2003 to 2008. And these were borrowers who had a range of loans from very small to very large. And they had 47 survey respondents of the 142, so that's a 33% response rate. So now that you have an idea of what the mixed methods approach looked like, I would like to compare this study to a study that we looked at in Module 7 to draw out some of the strengths and gaps in the alternative bank approach. First, I would like to highlight the strengths of the mixed methods approach in general. You're able to get more robust findings when you're able to collect both quantitative and qualitative data. So this is definitely a worthwhile effort in evaluating the program. And they used a concurrent mixed methods approach in that they collected quantitative and qualitative data on separate questions, then compared the results and there. We looked at a mixed methods approach taken in Ireland on a Big Brothers Big Sisters program in Module 7. And while this study used an RCT method, they also highlight some of the key challenges and critiques that they faced in their mixed methods approach. And I'll be using these to highlight some of the strengths and weaknesses of the alternative bank approach. One of the glaring gaps that they highlight in the alternate case, and that we as a group struggled to look past, was that this was not a comparison design. They did not compare the borrowers in their program to people who did not participate in the alternate program, making it hard to draw conclusions about causation, and in some cases even correlation. The next issue we see is sample size. One of the key weaknesses of the Ireland study is that it is small, potentially too small, and they acknowledge this. Their sample size was 162 people. The alternate bank study was only 142 people, of which only 47 responded to the survey, making it most definitely too small and compromising its credibility in our opinion. In the RCT case, they outlined some of the ethical standards that they grappled with, which I think is quite responsible. The issue with the alternative bank study is that they don't outline ethical considerations at all. Many of their borrowers are from marginalized groups, which brings about a further layer of ethical consideration, which this study doesn't address. They also looked at stakeholder commitment in the Ireland study. So they were asking if the varying commitment levels of different stakeholders might affect their findings. And the alternative bank stakeholders certainly have more to gain from the study than the borrowers themselves. And the power imbalances at play between the lender and the borrower should be noted in the way that they design their study. They also looked at alternative influences that could affect their results in the Ireland study. In the alternative bank study, I think that there are a few places they made assumptions that they could not control for, where there was lots of room for alternative influence on results. Broadly, because there was no comparison group, it is hard to determine correlation between the program and borrower success, so we can't rule out alternative influence in many cases. More specifically, they make some assumptions that are pretty far-reaching. For example, they say that 75% of borrowers only have to borrow once, meaning that the need for a future loan was lower because their earning potential was higher. I think there could be many alternative influences that could affect why a person would only borrow for a loan once, and they fail to explore this possibility or control for it in the study. One of the strengths that they talk about in the alternative bank study is that it is both retrospective and predictive. They say it's retrospective because it looks at past borrower data, and predictive because they assess the extent to which borrowers' participation in the microloan program was associated with expected outcomes. So this is a strength, being both retrospective and predictive. So that's an overview of their mixed methods approach that they took. So I do think that there are quite a few gaps in this approach that they've taken. But of course, there are some strengths as well.
Logic models are think tools for program designers to assist in validating their causal link assumptions between the program elements that contribute to the realization of intended outcomes for intended beneficiaries. Logic models can be overly simplistic and unrealistically linear, yet can greatly assist in communicating the basic structures of program interventions, what the intervention includes, and what it does and why. Logic models are best used for developing, managing, and evaluating interventions so that those interventions can be tested against initial assumptions and evidence from previous evaluations or research. The logic model outlining the theory of change for the Alterna Savings Microloan Program presents a linear chain from inputs through activities to outputs outcomes, and impacts at 3 different levels: the micro, the meso, and the macro, for 3 different stakeholder groups of borrowers, governments, and the credit union itself. The use of the logic model framework in evaluating the impact of the Alterna Savings Microloan Program helped to make explicit the program's theory of change and was useful in more precisely defining and assessing key outcome indicators of interest in the evaluation. Those indicators were, at the micro or the individual level, increased borrowers' payment of federal and provincial income taxes, reduced number of borrowers relying on government assistance, and enhanced well-being of borrowers and their households. At the meso or credit union level, enhanced corporate brand differentiation, increased customer loyalty, and promoted self-employment programs and services. At the macro or government level, promoted self-employment and entrepreneurship among vulnerable population groups in Toronto, and contribution to the reduction in the local unemployment rate. These indicators, as outlined in the program's theory of change logic model, are the performance measurements on the efficacy of the microloan program. As suggested by C4D Hub, key performance indicators should match the identified information needs of the evaluation. Moreover, McGinty suggests that evaluation indicators are more reflective of participant experiences when they are locally based, non-prescriptive, reflexive, and they safeguard against elite capture. A significant critique of the key indicators used in the Alterna microloan savings programs are that indicators were established without participant involvement, and that the results of the measurements of those indicators were skewed to benefit Alterna and the credit union as a whole. But how valid is this theory of change on the contribution of the microloan program in achieving these impacts? The logic model for the Alterna microloan program relies on several causal link assumptions, from inputs to impacts, that require more focused reflection. These causal link assumptions, as Main suggests, can be thought of as likely necessary assumptions, events, and conditions that almost always have to occur for the causal link to work. The microloan program rests on the rational assumption that providing access to small loans to new or low-income Canadians, supported by financial literacy programs and professional development opportunities, will contribute to positive impacts as measured by the impact indicators across the micro, meso, and macro levels. Some key assumptions here are the salient assumption that access to microcredit and small amounts of capital are key components for self-employment. The causal link assumption that financial literacy and professional development programs can enhance the effective use of microloans to implement self-employment opportunities. The reach assumption that microloans to new and low-income Canadians are the right group to materialize the intended impact from these loans. The capacity change assumption that microloans, financial literacy, professional development opportunities, and program awareness actions will result in the improvement of borrowers' capacity to apply capital more effectively in self-employment. The behavior change assumption that microloans will benefit borrowers' financial management both incrementally and fundamentally. The direct benefit assumption that the microloan and the professional development opportunities are directly related to the intended impact, that being increases in self-employment, increases in business for the credit union, and increases in tax revenues and decreases of support payments for all levels of government. And finally, the well-being assumption that due to the provision of these microloans, the social, the economic, and the financial stability of the borrowers and their families will improve, government tax revenues will increase due to increased employment, and that government support payments will decrease for the same reason. These assumptions provide the foundations for the theory of change in moving from inputs to impacts. The validity of the logic model rests on the realization of each of these causal link assumptions, and furthermore, each assumption represents a risk to the authenticity of the logic model. One very large critique of Alterna's microloan program's causal link assumptions is the lack of explicit clarity and connection of these assumptions in the logic model, and the lack of prior research and evaluation findings that can support some of these causal links. How valid is the microloans logic model in testing the theory of change using the interventions of microloans and professional development opportunities to achieve the intended impact? As Poston suggests, programs are theories, and logic models allow evaluators to question and test those theories so that they can be strengthened for future application. The ideal is to begin with a theory and end with a refined theory, as the evaluation is a process of testing this theory, identifying its failures, and retesting a refined theory of change. The evaluation of the Alterna Savings Microloan Program did not offer any reflections on the potential failures of their logic model, implying that indeed their logic model is correct. Logic models present simple and concrete pathways from inputs to impacts, but in reality, programs are much more complex. Microloans and professional development opportunities are presented as simple interventions where the cause and effect can be easily understood. As Funnel and Rogers suggest, simple interventions are those that look simple, work in a simple way, are standardized, carried out similarly in different contexts, work the same for everyone, are both necessary and sufficient for program outcomes, and there's an agreement on the expected outcomes of the intervention. The Alterna microloan program reported convincing results to suggest that this simple intervention could be attributed to the positive outcomes as measured by the performance indicators chosen by Alterna. Indeed, the findings reported include, at the micro level, 2/3 of borrowers with incorporated businesses saw increases in their income. 45% of borrowers who did not incorporate saw income increases. 2/3 of all borrowers reported that the microloan as their primary income. A 19% change in the number of borrowers who rent as opposed to own their homes. 41% of the respondents said that the loan improved the economic status of their whole family, with 47% purchasing assets with the loan. At the meso level, 62% of all borrowers were women. 75% of all borrowers received only one loan. 90% of all borrowers paid back their loan on time, this representing a solid line of business for the credit union, for default rates are superior to commercial loans. 2/3 of all borrowers were retained as customers by the credit union, and microloans brought in over $1 million worth of new business. At the macro level, 37% of all borrowers hired at least 2 employees, 25% of all borrowers hired on average 4 employees, and a 20% decrease in the number of borrowers receiving government support payments. Given the findings of the evaluation of the microcredit program, the suggestion here is that intervention can be confidently attributed to the positive outcomes of the program. A major critique of simple interventions is that the constant relationship between cause and effect, suggesting that this relationship is not only easily measured, but easily understood. Patton would infer the assumption that there must be only one single way to do something is highly suspect. Most simple interventions are indeed not simple at all, and in reality, more complicated and complex in nature, involving many components and factors that involve reinforcing feedback loops and that are hard to model effectively. Caution is warranted in interpreting the findings of this evaluation based on the logic model, for as Funnel and Rogers would suggest, simple logic models that have all the inputs and processes at the front can produce misleading representations of complicated interventions. A recommendation would be to reassess the validity of the causal link assumptions that build the logic model for Alternative's microcredit program with more research and evidence. Then refine the logic model to reflect both the knowledge learned in this evaluation and triangulate results and high-quality lessons learned from other research on the efficacy of microcredit savings programs on improving the lives of low-income populations through self-employment.
The third evaluation method used in this case was called stakeholder engagement or participatory evaluation. This was described as the stakeholders in a program play a key role in co-designing, co-implementing, and taking action on the evaluation. We immediately asked ourselves if this stakeholder engagement or participatory evaluation was simply a precursor to developmental evaluation. At the time this case was being evaluated, developmental evaluation was gaining traction. This case was published in 2012, and Patton's book, which appears to be the definitive guide to developmental evaluation, was published in 2011. And this, of course, is fresh on our minds from last week's Module 10. If you recall, in the reading Evaluating Social Innovation, Preskill and Beers propose 5 characteristics of developmental evaluation. 1. Developmental evaluation's focus is on social innovation where there is no accepted model, and might never be, for solving the problem. Alterna was offering a microloan program whose support is all the more relevant because the community business centers, which help these micro entrepreneurs to prepare business plans and provide them with advice and training, do not offer financing. However, the added value of the Alterna program is not only the provision of loans to qualifying borrowers, it is also the creation of a peer network and professional coaching opportunities that aim to enhance borrowers' businesses. 2. Continuous learning is intentionally embedded in the evaluation process. As you heard earlier, Alterna was looking to strengthen their program through this evaluation exercise. 3. An emergent and adaptive evaluation design ensures that the evaluation has purpose and that it can respond in nimble ways to emerging issues and questions. We did not find any evidence of this based in the information that was provided. 4. The role of the developmental evaluator is a strategic learning partner and facilitator, which reflects a different role for most evaluators and their clients. As I just mentioned, Alterna was looking to the stakeholders in a program play a key role in co-designing, co-implementing, and taking action on the evaluation, which we assumed would also be reflected in the partnership with the Carleton Centre for Community Innovation as the evaluator. This was confirmed when the case described stakeholder engagement was in practice the facilitator, coordinator, and synthesizer of the application of other methodological tools in the study. In the Alterna case, the co-leaders of the study, Alterna and Carleton, jointly decided how and when to apply the tools. 5. The developmental evaluator brings a complex systems orientation to the evaluation. There was no information provided regarding this. All right, so let's look at how they used stakeholder engagement. This is what we learned. Borrower participation in the study was more limited and narrow in scale than the management's participation, management being Alterna. Respondents to the questionnaire participated via an online tool. A smaller number of borrowers participated in focus groups. Alterna's participation occurred during the design of the study and the construction of the borrower database. 3 key Alterna staff members, including the senior executive responsible for corporate social responsibility, played an active role alongside the Carleton Center's researcher and supervisor. The writers acknowledged that in future studies, borrower engagement could be expanded and their voices amplified in the social accounting process. What did we conclude about this third evaluation method, stakeholder engagement? We came to 2 conclusions. First, that for Alterna, the study was not only to internally assess the effectiveness of its activity, but also to externally strengthen the credit union's market position and strengthen its role as an advocate for more government support of microcredit programs. We really felt this evaluation project was self-serving. Secondly, this felt to be more like a research project than an evaluation of a program. Had this been the hypothesis, credit unions are important managers and supporters of microloan programs and not only reduce poverty, but contribute to the bottom line of credit union business, then this could have easily been used in the research context. This was substantiated later in the case when the evaluator was referred to as a researcher. We also failed to see measurable goals regarding the impact of the microloans. We were only given the results. Nowhere did the evaluation show how things could be done differently so as to have a greater or substantive impact on microloan programs.
The results of the Alterna microloan program evaluation would suggest that the simple intervention of providing small amounts of capital provision supported by financial literacy and professional development opportunities can be attributed to the improved economic and financial lives of program participants, the increase in business for the credit union, and the increase in tax revenue for levels of government in a simple and linear cause and effect relationship. With the group's assessment on the 3 approaches used in this evaluation, we want to provide you with an opportunity to reflect on the most fundamental question of program evaluation. Not so much did it work, but did the evaluation generate enough learning and knowledge to refine the theory? Here are some discussion questions to further assist on the reflection of the assessment of the Alterna microloan program. How would the results of this evaluation be affected if the indicators were chosen by project participants versus Alterna Savings Credit Union? Was the evaluation too quick to move on measuring success with the given key performance indicators? Can the knowledge learned in this evaluation be transferred to other contexts? And what element of the evaluation approaches presented by the group would you have improved upon? How would you improve upon these approaches? Thank you for spending time with us assessing this evaluation, and we look forward to continuing this conversation with you on the discussion forum this week.